Well, hello everybody, and welcome to another live event here on the Pepperstone channel. Today we've got a great topic for you. It's of course learning to trade Forex trading for beginners, and there might be a little bit more advanced concepts as well coming in today so that we can bring it all together to understand how to trade Forex better, and more importantly, how to understand these Forex markets in what is a very volatile year, and of course a great year for be trading Forex and other instruments as well with Pepperstone. So hopefully everybody enjoys today's session. If you do, make sure to give us a like on the video, and of course put your comments in the room as well, whether it's before or after you're watching this on a replay or just a live stream. Always be sure to put your comments down below. We do read them, and of course we take the feedback on board, which does help us out. So some of the things that you're going to be learning today, that's always very important for us to understand some of the concepts you'll be learning. Of course, Forex day trading strategies. How do we go about really applying some of the strategies? We're doing some live analysis of the charts right now, so feel free to ask us some questions. We'll go through some of the charts and we'll have a look at some of the key technical areas. We'll also be talking about one of the big central bank issues at the moment, which is of course the Japanese yen, and some of the concerns that some people might have around that. Then we'll look at a few key indicators that we like to use, and of course a live Q&A at the end. So if you have questions throughout, we'll try to answer them, but we will answer some extras at the end if you get them. Plenty of people coming in here. Thank you very much for joining us for the session. And I think we'll get started by just discussing which pairs are really best to start with as a beginner. And as we know, beginners, it's all about pair selection. A lot of people start to trade with maybe the wrong pair. I remember the first time I ever traded, I think it was Euro US dollar back in 2007, 2008. And then we moved on to, I remember the Mexican peso was the next one I traded. Let's just say the spread for that one wasn't the same. So where do we really get started? Well, generally it's the majors. It's the more liquid currencies that you want to start off with. That is US dollar majors, and of course the yen basket pairs, as well as some people's favorites, things like gold and some others. You know, these are big one: gold versus US dollar, gold versus odd, gold versus euro. A lot of people don't know that Pepperstone offers gold versus other pairs. And sometimes if you spot, let's say, one of these currencies is particular weak, e.g. for at the moment, the yen is quite weak and you think gold is very strong, what about gold versus yen? That could be always a very good type of thing. And we will look at a few of these on the charts as we go through this beginner session. A lot of trading and selection is about recognizing which pair is strong and which pair is weak. A lot of people don't even know when they trade, let's say, odd versus US dollar, that they're really doing a long short strategy. That is, they're buying odd strength against US dollar weakness. We've got Tyrone joining us now. Hello, Tyrone.
Hi, everyone. Yeah, over the technical issues, we're back.
Yeah, fantastic.
We've got a computer failure this afternoon, but that's okay. We're all good. Yeah, and hello, everyone. So
cool. So basically, we've just gone through a few pairs. A lot of people don't know, Ty, that really it's all about relative performance, and that is finding the strongest and the weakest pairs in the market. That's actually pretty much the foundation of the beginnings of Forex trading. The other thing that Forex traders want to think about is whether they want to be a day trader, a scalper, or a swing-based trader. Most people come in and the beginners all start at scalping.
Yes.
Because the allure of getting in and out very quickly is, of course, very fun. And on top of that, it sounds like the best way of making money. Scalping certainly is very good, but the thing with scalping is it's all about understanding the multi-time frame techniques. And we'll give you a bit of a strategy today that you can use to really break down some from the top all the way down. Whether you're trading a 15-second chart, a 1 minute, a 2 minute, 3 minute, 5 minute, we always want to remember that when we're talking about price action, or we're talking about structure in markets, and that's so important that retail traders don't do, we need to make sure that we're very well aware of where the bid and the ask start, and also what's happening on the higher time frames. Remember, an algorithm might trade the small time frames with you, possibly other retail traders, etc. But what doesn't happen, Tyrone, on the small time frames is that we usually don't have necessarily the biggest money flow. It comes in there, but the biggest money flow shows itself in the weekly and the dailies. And that's where we get hold of those bigger trends that we'll discuss today.
100%. Yeah. And a lot of people, I think knowing your expectation is probably the important thing there. Like a lot of people probably expect big money flow in those time frames, and it's just not going to happen. So really understanding what you're trading and the time frame that you're trading is really, really important, because it's knowing your expectation. And really, the market will do what it's going to do, not what you want it to do. So really, you have to work with it, not have the market work for you. If that makes sense, you really need to understand which market you're in.
Well, part of that pair selection becomes a big part. We always talk about if you want to be a day trader and a scalper, the best time to trade often is around the session opens, around 30 minutes to 1 hour before the market opens, to usually around 1 to 2 hours after the market opens. Some of the biggest trades happen at those periods of time. We've got a few people, it sounds like, joining us from Europe here today, Ty, and they have one of the best Forex time zones. There's no doubt that the European Open and the London Open are incredibly great to trade in Forex and to recognize breakouts. But also the other one that's fantastic is the crossover between London and European, like lunch, into the New York Open. Tends to be a very good index play as well around that period of time.
Yeah, 100%. It's really important to understand that too. Like, not knowing when markets are open is probably one of the biggest things that people fail at the start, isn't it, Tom? Like, generally they can't work out why markets are moving at certain times of day, and then they come to the realization that it's a market open, and it's like a revelation. But it's a really important thing to understand. And look, there are indicators out there that actually show you which markets are operating at particular times as well. So if you're new to Forex trading, it's probably a really good idea to actually understand exactly which market you're trading.
Yeah, and the pair selection around that time, if you're trading the London Open and the European Open, you might want to stick to the euro, the pounds, other European pairs, CHF, etc. All of these types of things just make sense. Are they going to move more in their market? Absolutely. If you're somebody that comes from the Asian region or Australia, then we would want to be looking at the Oz, the yen, and other pairs around, the Singapore dollar, those types of things. So just always stick to knowing that if you're going to day trade and if you're going to scalp, the best time frames are often around the opens for the bigger moves. And then on top of that, you're also wanting to do pair selection during the opens in particular. And that's just so important. So Ty, we built a lot of our courses and a lot of our structure, everything on recognizing trends and recognizing trend changes. We're going to give you two kind of strategies today that really help out with recognizing trends. But one of the biggest beginning lessons in all of trading is to understand that markets, if they were acting perfectly technical, will make a series of peaks and higher troughs if they're in an uptrend, and of course lower peaks and lower troughs if they're in a downtrend. And it's this sequence of events that happens usually across multiple timeframes that allows you to potentially place better positions. If you know something's in an uptrend and it's pulling back from coming out of an uptrend or in an uptrend at all, if you know that's happening on, let's say, a 1 hour time frame, but then you can go into, let's say, a 1 minute time frame and spot a literal change of trend within this area, wouldn't that be powerful? Well, the answer is simply yes, it would be. It would be incredibly powerful. And it comes up with the most common concept in really price action-based trading, which is based on support resistance, and that is role reversal. Now, what is resistance and what is support, Ty? I guess most people probably out there know it now. But what resistance is think of it as a price or an area where the market has moved towards, and then for whatever reason, people have either taken profit, that is closed their orders, or resistance selling has come in. Think of it as the bears have come in or the negative down sellers. So really, it's just more negative options or more negative instruments are being placed in terms of whatever orders are being hit here, and the market is moving down. And then as it comes back up, again, because that has already happened before, people again start to say, well, maybe I need to take profit here. This happens around psychological areas. This happens around just random areas sometimes in the market, but it's something you must pay attention to. And if you know you're in an upward trend and you see this type of thing occur, just like I'm drawing here on the screen, this can be a perfect place for someone such as a scalper or a day trader to come in and say, okay, I've recognized that on the 1 hour. Can I now see a change of trend that is a smaller lightning bolt or a smaller change of trend occurring on the smaller time frames? It's imperative that you bring together multiple reasons to get into a trade, and role reversal is one of the most important, isn't it, Tyrone?
It is. And look, there are many traders out there that only use role reversal and support and resistance zones just to base their trades on, and they're very, very successful. So understanding it is probably part of the part of the problem is actually identifying where they are. That's where people have the most difficulty. But when you do know how to locate it, it makes it very, very easy to trade off those levels. And probably just as importantly, Tom, it keeps you out of trades when you're actually going against it. Like a lot of people don't realize they're trading into resistance when they first start out, and and then the market goes against them, and they're like, oh wow. And same as support. Like it's amazing how many people will actually short into a support level, not understanding that it's actually there, and then they can't work out why the market's always going against them every time they place a trade. So identifying these role reversal zones is a really key point to, one, keep you out of trading in the wrong direction, but also give you a launching pad and an area where you know the market will react, but in a positive way. So you want to be working with it, not against it.
So there's a great question in the room today, and it's from Andrew, and he says, I get caught out with stop hunts, etc. a lot, and that's hard for a beginner. Absolutely it is, Andrew. And stop hunts are one of those things where I always have like a mantra that I guess I've been really teaching people a lot, even more so now that we have such a volatile market. And if you probably take these words away, maybe they'll make more sense to you when you start looking on the market. And the words are patience, react, don't predict. And it sounds like when you're doing technical analysis that you should always be, oh, we're predicting it's going to go here, and we are. And yes, in essence, we are trying to predict certain areas. But what we're doing more so is reacting to certain things. See, imagine, Andrew, if you changed your trading style, and I'm saying this to everybody out there, really. Imagine if your concept was, well, instead of actually placing positions until straight away in the areas that I think the market should go to and the market should respect, such as even role reversal. Imagine if you waited for things like, let's say, stop hunts, and your system was based around recognizing a stop hunt. And for anyone that doesn't know, I know it's a beginner episode, but basically stop hunts plague everyone. In role reversal, they're incredibly common. And even in this example here that we've got on the screen, in many ways, the stop hunts are actually happening in this type of market. The market's gone bullish. It's found a point of resistance. That's a 1, 2, 3, 4 hit. It's then gone down. It's come back through, and then it comes back down to this level. Now, often what Andrew's talking about, everyone, is that this level is respected. And you can see here there's a bunch of wicks. These wicks, in essence, show us demand of buyers wanting to pick this particular instrument up, being the euro US dollar. What if in essence you saw something like this occur and the market comes down, going through all these previous levels, and then it reversed to go bullish? And then after that particular candle, you said, I know what they've done. They've taken out all the liquidity here. They've done the stop hunt, and then it moves off. The actual essence of being patient, so patience and then reacting to it, has actually allowed you to not necessarily make the same mistake. And I think that's super important for traders of all levels out there today, whether you're a beginner or an intermediate or an advanced. It changed the game for how we perceive markets. If we look at an area and we say, I like that area, and I say to Tyrone, hey, Ty, I've got this zone here on the euro US dollar. Do you want to take a look at it? And then we look at it, we say, yeah, look, it certainly could move off that level. Could, probably, all these types of words. Well, what if we see a hunt? What if we see something like this style and this type of thing? All of a sudden it becomes, we see what they've done. We know what effectively the market is doing in terms of manipulation. And this is often a very good go signal that the market is going in that direction. And by that point, you're actually stacking more odds in your favor. So by being very patient, changes the game, Ty. Changes the game.
Oh, most definitely. And when you see that happen, like that is a real advantage when that actually does happen, and you see that sort of candle effect, and it happens a lot. I mean, that's I know we drew it there. It wasn't in this example, but you'd be amazed how often that happens.
Absolutely.
And really, it is the market just doing what the market does, and people feel wounded by it, especially if you get caught up in it. Yeah. But in saying that, you know, when you identify it and you know what's happened, and you jump in after it's happened, then you realize that you are actually participating rather than being absolutely scolded by what is effectively a very natural move. It may look unnatural at the time, but believe me, it's not. It's very, very normal. And taking advantage of the after effect, if you like, is a trading plan in itself, isn't it really? It's just understanding it and being able to participate after it actually happens is a very, very big key.
Absolutely. And I'll actually bring in a live example from the last 24 hours where that's actually occurred. and it's not a currency one, but it is in something that everybody out there likes to have a look at. And of course, that's an index, a very powerful index, if anyone knows what I'm talking about. Let's see if anyone in the chat might have a bit of an idea where one of these types of nasty kind of stop hunt, nasty traps has been set. Let's see if anyone knows. If you do, put it in the comments right now, and I'll tell you if you're correct on that one. CBS also has a great question here, Ty, and I'll answer this along the day of the actual doing this particular video. And it's, how do you find an edge to grow your capital? Well, it's a great question. The easiest example of growing capital would actually be to jump over to our website, fxevolution.com, and download the Presic account builder. And what I mean by that is it's a way of really compounding if you are winning, and you're rewarding your account, aren't you, Ty, when you actually are doing well. But the second thing there is being able to create a replicable system. Too many people go, I feel it. I feel it, Ty. I've got the gut feel that it's going up. I know it's going up. Why?
I just know it for sure.
I just know it, guys. And unfortunately, I say that a little bit too much as well. And if you have something like that, it's usually a sign you don't necessarily want to be doing that placement, because how are you going to replicate that trade thousands and hundreds of thousands of times over your trading career?
Yeah.
Well, the answer is you probably can't, can you?
Now, a trading consistency is one of the most important things. There's no question about that. The Presic system is a free, it's ironically free, and it's, you know, it's amongst the most powerful things that we've actually got available on our website. So highly encourage you to actually download it, watch the video, and follow the plan. And if you can get to the level 3 trader, that basically you have to do to finish the that section, you will know that your plan works, and you will know that you are a trader. You've made it at that point. There's no question about that. And there's no denying that you have. And I think, look, trading is confidence, okay? You must have confidence in your ability to identify trades. You must have confidence in your ability to actually follow a plan to the letter over and over and over again. Getting lucky. It's amazing how many people come to Thomas and I, and they get very, very lucky, and they've had a big windfall because they've, you know, generally risk too much, but it's actually worked out for them. But not long after that, they come back and they've lost everything, and probably more than they've actually put in, haven't they, Tom? Like they generally chasing their losses because they expected that to happen again. That's not what trading's like. Trading's not Taslotto. You know, trading is a replicable business where you find and identify a strategy that works. We talk about, you know, 10 or 15 different strategies every single week that we know work in all of our webinars, and following it to a T. Very, very important. And when you get that and you understand that, you're 3/4 of the way there to actually being a professional or a full-time trader. It's all about being able to replicate what you can see and how you can act on a everyday level. It's just how it is. And it sounds boring, and it might not be what you want to hear. But hey, guess what? Technical analysis is history repeating itself. It's the only reason we're here. It's the only reason we talk about it. It's basically identifying historical events that happen over and over and over again. And that comes down to price action. So as much as it sounds like, oh, well, that can't be, it is that easy when you identify the right strategies.
So really, there's two main theories to being able to get into trends, which is, of course, one of the principles that you want to usually apply as a beginner trader. They say the trend is your friend. It is really your friend in terms of being able to get in them. But you also need to understand, well, how do trends start and how do trends end? Can we simplify that approach? Well, there's a yes and no answer to that. There's kind of cheating ways that you can use certain indicators, such as moving average crosses. Does that work all the time? Unfortunately, no, it doesn't. But that compiled with other concepts can work. Yeah. So we have here what we call the Dow theory. We've brought it up plenty of times on this channel, and we've talked about it before. Basically, there's this idea that trends such as bull trends start in phases. They start in phase 1, which is accumulation. Now, accumulation will look like this on a chart. It'll look something like this. Effectively, the market may have come down. The market then stabilizes. Effectively, the sellers and the buyers kind of have a yin and yang in terms of they come together, Ty, and the sellers and the buyers kind of meet each other. And then all of a sudden, the buyers end up gaining the commitment to trade that particular direction and break it out. And there suddenly is a money flow into that direction. That's what we enter as the public participation phase. And if we can get into this phase, this is the perfect area for beginner traders, if you can find it, to be getting in. Now, there is another phase, and that's the third one, which is called the excess phase. Traditionally, this is where most retail traders get into a position. Initially, during the public phase, public participation, a lot of people aren't convinced that it's in an upward trend, or they're confused, or they don't know what's going on. And then by the time they get convinced, we're in what we call the excess phase. And that's where basically what Wyckoff called the composite man, that is all of the market kind of people that are trading right now, and people that are investing, and people that are moving the markets, come in and actually start selling the positions back to us as retail traders. And if you ever wondered why you lose in these types of positions, it's because often when everyone hears about something, it's over. Some great examples of that in the last 2 years, Ty, would be things like GME, AMC, which are obviously stocks that most of you would probably be aware of, GameStop, etc. Also cryptocurrencies, things like Bitcoin. When that's going into excess phase, everyone's talking about it. They're extreme versions of the excess phase. Obviously, they're not always going to be talking about the euro, US dollar. Hey, did you see the euro went up this much last night? I don't think that's going to go that often into it. But I have seen cases of that. A classic one would have been the Australian dollar, Tie, back in 2013, I think it was, when we were reaching back around 110, and everyone had arguments to be saying I think it's going to $1.50, or I think it's going to $1.40. I'll never forget some of those big ones. And when that's happening and people start making outlandish comments, it generally means you're in an extreme excess phase within that particular market, and you need to start being very careful. But as a beginner trader, the idea, and obviously always the best thing to do, is can we somehow find the public participation phase? Now, we'll just quickly disappear for a second. This was Wyckoff's price cycle, and he basically said something very similar. He had the accumulation area, the oversold area. The demand was then greater than supply, effectively what he called the markup phase, which is, again, just public participation. And then he had the distribution area, which effectively was a mixture of the excess phase and, of course, the final stage of a trend. And inside here, usually the way that the market would look is something like this. It would go up like this. And your idea of trading would be to recognize when this is occurring and the trend's ending, and of course, trying to get in on some of this with your day trading and with your scalping. If you can somehow if you were looking at this particular trend, I've got a question for people. What trades probably shouldn't you be taking in a trend like this? Should you be taking only longs? No, you're not allowed to answer, Ty. Sorry.
I thought it was open.
This is a beginner live session. We need everyone else to answer. Well, okay,
right.
Let me rephrase that. What about over here? What type of trade should we probably not necessarily be taking if we don't know what we're doing in this particular downward trend? Which trade shouldn't we probably be looking at doing in that particular time? And it will go against most beginners' philosophies, because people, when they first get started, Ty, we all want to do the wrong thing, and we all want to go, of course, against the general movement in the markets. Let's see if anybody does answer that one. We'll keep moving on, though.
So obvious. When we talk about it, it looks so
obvious.
But it's amazing that most beginners will go the other way.
Mm-hmm. So Andrew says avoid the counter. Kalman says long. Absolutely, you are correct here. And then Kalman has a good one. Until the bend in the end. So I guess that's the trend is your friend until the bend in the end. A good one there. So again, we have a whole bunch of ways that trends end. This is just one of them. There are other ways that trends end are usually something like this, which is basically where you breach past a previous kind of support. So this is the previous trough. Remember that peak and trough kind of example we had before, and we make a higher peak, and then we breach below that level there, and we make a lower trough. And when that occurs, we've effectively changed the trend. We also have the Wyckoff schematic, which we've talked about in a previous webinar. So if you're interested in finding out that, you certainly can do so. And there's both the distribution version and, of course, here, which is the accumulation version. So let's quickly, before we actually take a look at the market, Ty, talk about the most basic indicator that we are going to bring in today, and that's the moving average. Now, most of you, if you've begun trading, will have heard of the moving average, or you may have put moving average on there. If I was to say to Tyrone, probably one thing in FX that I would like, I would probably go with a 20 moving average, 20 exponential or simple moving average. Doesn't really matter too much, but we would usually use a 20 exponential moving average. And we'll add one to the charts together today using the TradingView platform, which Pepperstone, of course, offers. And the 20 exponential moving average, Ty, it's a great one, isn't it? Because it kind of replicates, if you think about 20, why is it so good? Well, if we have 1 month, so that is 1 month of actual trading days, how many days is there that we usually trade? Well, 5 trading days a week. So it's around kind of 20 days. And if you think about the 20 EMA, what is that actually telling us, Ty? Well, so many people don't even know what a moving average is. So do you want to just quickly explain what the difference between these two are?
The simple moving average is actually the one that people gravitate to initially, and most platforms default to a simple moving average as well. And all that is really is the data points of how many or whatever that period is. So if it's a 20-day moving average, it's going to be the average of the movement of the last 20 days. Now, it's one thing people get confused about is, if you change your time frame from, say, a daily down to a 4-hour, down to a 1 hour, does that actually automatically recalculate? Yes, it does. Okay, so even though we technically call it the 20, sometimes we automatically just call it the 20-day moving average, but it's actually a 20-period moving average. So if you're looking at it on a daily chart and you've got a 20 moving average, a 20 SMA on your chart, and then it's effectively giving you the average of the last 20 days. But if you go down to a 4-hour, it'll automatically recalculate, and that 20 will be the last 24-hour candles. Okay, so it automatically recalculates so when you go down to a really small time frame, you're not seeing a 20-day moving average anymore. You're seeing on a 1-minute time frame, you're seeing the average of the last 20 minutes. That's really, really important to know that every platform just automatically recalculates that to the time frame. So the SMA is the most simple. Okay, that's basically just adding up all of the data points. That could be the close or the middle or the low, whichever. Generally, the platform defaults to the mid range, and then it just divides it by the amount of whatever the period is. So in this instance, is a 10 SMA. It's going to divide it by 10. Now, the other very popular moving average is the exponential moving average, which is the EMA. Now, what that does, that actually gives more weight to the front end. So if we were looking at a 10-period EMA here, you can see that by that little graph, a lot more weight is given to the 3, the 1, the 2, and the 6 than the 2, 2, 1, 4 at the back end. So what that makes it is a very fast moving average compared to the SMA. So it's a lot quicker than the 20 SMA or the 10 SMA because it's using the more forward data. So it's actually far more reactive. But the downside to that, you might say to yourself, well, why would you use an SMA instead of an EMA? The downside, of course, is you're going to get some more false breakouts in that regard because it is so sensitive to what's happening in the here and the now. It is a little bit more susceptible to false breakouts. So the SMA can be a little bit more steady. The EMA can be a little bit quicker, but it can be a little bit more falsy. Now, this is an example of what an SMA and an EMA actually look like. Again, you can see the blue EMA, which is the faster one. You can see how much faster it actually reacts. Now, you can see there, it turns a lot quicker, maybe 5 or 6 candles faster in that very first part that Thomas just highlighted. And so it can get you in a lot quicker. But again, though, you do get a few false signals. So you've got to be a little bit careful of that. Thomas and I always use EMAs on the smaller time frames. That said, so we always use the 20 and the 50, and they're always EMAs. And the slower moving average, which is a 200 that we use, is an SMA, because quite simply an EMA 200 doesn't really make sense using a weighted average of, effectively using the top end of a 200 candle counter is not really going to give us a great representation of what's really happening. That's more steady. So we go for the EMAs for the 20 and the 50, and we go the 200 SMA.
So we've popped back on the screen, Tyrone, but I wanted to kind of mention the concepts that we learnt before, which not so much in a perfect place here, but certainly in essence, they can be used together with the moving averages. So here we have a 20 SMA and a 20 EMA. Now, obviously, we don't know what time frame it is because we didn't tell you, but this could be a 1 hour. This could be a 5-minute, or this could even be a 30-second chart. It could be any of them. The point is as Tyrone said, it would calibrate directly to that particular time frame. If it's 30 seconds, it'd be 20 30-second candles that it's based on. So when we have an area like we have over here, where the market's coming down, what's it doing this whole time? It's making a series of lower peaks. So that's a lower peak. That's a lower trough. That's a lower peak. That's not a lower trough yet, but it's still lower than the last piece. Still a lower peak, new lower trough. And of course, then we have lower peak, then we have the lower trough. Now, it starts to turn around here, and we start to see a bit of a turnaround story. The key here, though, is think about the market structure. What also happens is the market goes from respecting the 20 moving averages. This is what we call dynamic resistance or dynamic support, where effectively the price is finding sellers each time it comes back to this level. And then all of a sudden, the price breaks through, creating a shift in sentiment. Now, listen back to those words the words of wisdom in some ways that we spoke about before. Patience, react, don't predict. Imagine if this was a 5 or even 1 hour time frame chart. We see the market break through the moving averages, and you might say, that's interesting. I'm certainly excited about that because it means that this 1, 2, 3, where it was acting as dynamic resistance, has stopped. We then see the market pull back down, and we're like, whoa, a bit scared still. I'm not too sure what's happening. And then the market goes long and moves back through. In essence, this is the beginning of what we call the lightning bolt: the trough, the peak, the higher trough, and the higher peak. It's kind of the first signal that we have a change of trend. So if we were to go to a very basic trading style and you were to think about it, we know a few things. The market acted as technical resistance. This was dynamic resistance here in the downward trend. The trend then changed on the lightning bolt concept. And then we then saw the market come up to this level here, which was the previous level of resistance. And we saw rejection and rejection. So what happens here is basically the sellers try to push this level down, because after it gets past this level, the likelihood that this market has not only turned, but is going to significantly turn and start turning up becomes much higher. And if you know and you structure it and you think about the Wyckoff kind of concepts and stuff like that, it'll make a lot more sense. But basically, once this breaches through here, and yes, it's a lot of waiting, and I understand that, it actually becomes very likely that this market is going to go up. And not just that it's going to go up, it's probably going to breach this previous level of resistance over here and keep going. Now, notice when the market comes up, what's it do? It comes back to the 20 moving average, and then it comes back to the 20 moving average again, and then it probably will eventually come back again. Now, because it's created a sequence, which is 1 and 2 respects, plus, on the left-hand side, it's respected before, this could be a very fantastic level as well in the future for you to be coming and having a look at if it happens around, let's say, a London Open. Let's say this was the Euro or anything like that. So moving averages can act as dynamic support resistance, but also you can bring across the concepts of higher peaks and higher troughs, market structure points, and then turns in the overall market. What if the conditions were before this whole thing was in just a massive upward trend? What a fantastic place for us to be able to build a story tie to potentially be getting into towards the long. And you can see how the market reacted after it broke through. It went ballistic.
Most definitely. And I think people, like, you might be looking at this and saying, well, that's fairly simple, Tom and Ty. Like, surely it's not quite as easy as that. It actually is. And a lot of the time we do get asked, what if you only could have one indicator, what would it be? And if I was, held at gunpoint and you said to me, you're only allowed to use one more indicator for the rest of your trading career, I'm going to go off the 20 moving average because it's the one that's going to give me the most amount of information. And just as importantly, it's going to get me in the most amount of trades. Now, using a lot of tools, it's a little bit like, if you said to a carpenter, what's your most valuable tool? He's probably going to say a hammer because that's going to be the thing that actually allows him to create. The MAs are very similar to that because it allows you to create the plan around what you're seeing. So what we just described there was, effectively using the 20 EMA or whichever one we had there to actually push the market down and treat it as dynamic resistance. And that very same tool becomes dynamic support. So not only is it hammering the nails in, it's actually also pulling the ones that you've bent out. So you're able to use the same tool to actually pick the same sort of trades, but in both directions. So it's the most valuable tool in my mind because it's the one that is the most adaptable to what you're trying to achieve, no matter what time frame you're on. Like Tom said earlier, it doesn't matter whether you're on a 30-second chart or a 1-month chart. The same signals are being given, just in a totally different time frame.
So let's move over time and learn how to add the moving average to our chart. So we can go here to moving average exponential, the one that we prefer. That other one was a simple. And you'll notice it comes up with a little blue kind of line here. And we can right click on it and go to settings, or you can visualize them up here. And then basically what we can do is we can put the length in. So we can say here 20, which gives us the 20 moving average. And Tyrone and I like to give the 20 moving average the red color because we all know Ferraris are relatively fast and they're mostly red. Yeah, Ty?
Yep.
You don't buy a Ferrari if it's not red. Is that correct?
Red sports cars go faster than blue sports cars, so it's inevitable.
Or yellow ones. We like Lambos as well, yeah.
Well, yeah.
Anyway, why I wanted to put it on the chart is not so much for the US dollar yen overall. It's more just to make sure that you guys know how to add the moving average, and that's the exponential one. Now, what I want to focus on though, Ty, was when a trend gets started, because we had a great question here, which was from Andrew, and we will go and look at the stop hunt. But I wanted to talk about one of the the second thing that I really wanted to discuss in today's session here, and that was to start framing the market. And that is what you're looking for is you're looking for periods. Remember, the concept was the market would go into a trend. It would then usually find a distribution or accumulation level, and then it would go to the next kind of zone. So when I talk about framing, and Tyrone and I talk about this, we basically want to create maybe some form of box, which you can do here by calling the rectangle tool in TradingView. And you can start to look for concepts of highs and lows. So when you start to look for these types of things, you can say, okay, well, are we breaching out of these zones? Are we finding an area of consolidation? Are we showing levels of stop hunts and things like that? A classic case here is not so much this one here, but over here on the next side. So basically we get quite a few things, and this goes back to Andrew's question. The first one is we get what we call, or many people would call, a flag style pattern. So here is the beginning, because remember, it's easy to see things when they're happening, but when you go back, you've got to be honest with yourself and say, well, what was that? So here's a classic, in many ways, flag style pattern that's occurring. Now, patterns don't always work out, and this is one that classically, of course, didn't in some ways. What it actually did was it breached below, causing what we would call max pain or a false break to the downside that then was incredibly reversed back and up. This type of position, if you recognize it and you know what that pattern was meant to be and what that pattern could have been, can be very aggressive style positions. The other thing that happens here is you need to understand that what occurred here, what orders were placed as part of this whole manipulation into the trade. So the trade goes negative, goes underneath where the flag should be, and then rejects. It happens a lot. The market then often does go in the direction of the trend, which enables you to go into the smaller time frames, because this is a daily, and then start to look for longs because you've seen this aggressive reaction back into the trend. That is the max pain. So if you've been patient and you're reacting, this is a great level to react to. When the market then comes back down later on, you'll notice it claws its way underneath this level, effectively liquidating all stops that are underneath there, and then fully reverses. Now, I can already tell, Ty, there is structure in here on the smaller time frames that would be very interesting to look at. And this is all happening, remember, in the direction of the prevailing weekly trend. I don't think anyone will look at this chart and not say, oh, that was in an uptrend. It clearly was. I think everyone can see that. But because it's in an uptrend, the upward momentum shift moves tend to be the better ones to be in. So if you see this false break to the downside, if you see this structuring setup that ends up happening through here, both of those can become very, very good positions to potentially look for longs. And all of these other subsequent ones can be little bits where it goes underneath previous lows and then ends up reversing in the direction that you thought it would go to. If you were patient enough to wait for this candle rather than predicting anything, wouldn't that show you, wow, I see this level got taken out. That's probably some kind of stop loss hunt. It's then rejected. Maybe I can find a buy throughout here because I can see that this has fully changed the structure and the way that it works. Now, I promised before that we'd show an example from the previous session, Ty, and I'll use the US 500, which is the S&P 500 for an example. And we'll go over here to a 15-minute chart because this is exactly what we're talking about. Basically, we have a market moving up. So the market is going, breaches through, higher trough, higher peak, higher trough, higher peak, higher trough, just higher peak, okay? So just higher peak, and we'll come back to that in a second. But if we're framing this as a box, let's think about it. We have the top area, we have the trough, and we've got this little breakout down here. Now that gives you a bit of a signal that maybe there was a false break to the downside, and maybe you could find a little buy up until the top of the box. Certainly a very good possibility. But it's what happens at the top of this box that's really interesting, because the market actually goes up, it breaches by a few pips, and then it goes straight down, like very aggressively down. And as you shift this to different time frames, so we'll go to the 2 hour here, you'll notice this big rejection coming through. Let's have a look at the 4 hour here, huge rejection candle, and we'll check the 1 hour, big again. So depending on what time frame you're actually set on, this particular market goes through, activating longs, and then instantly rejects those to go back down. And you can see the aggression at which this market reverses the position. This, if you can spot it, which is a bit of a more advanced technique, but if you can spot this type of breakout from your box, whether it be the breakout down the bottom here or the breakout up here, and the way that it then trades after that can be incredibly powerful. But you have to have a ton of patience to look for these things, don't you, Ty?
You do. And, and look, patience, we always advocate that, patience is really part of trading, and it's actually a trading strategy in itself, because forcing yourself to take a position before the market is ready to actually move is really putting yourself at a significant disadvantage, because for one, you might not be ready to take advantage of the move because you've entered some stupid trade because you felt you needed to trade because you invested so much time. But just as importantly, if you are the first person trying to actually, move the market, so to speak, you're the one that's going to get burnt if the market doesn't actually, do what you expect it's going to do. Whereas if you had the patience, you wouldn't even be in it. So not only if the market doesn't do what you expect it to do, probably 8 times out of 10, you won't even be in it. And I think that's the point, that you're not actually being burnt or hurt by a market that doesn't do what you anticipate it's going to do. And that's where patience really helps. I know it's a boring word, and I know people, they want to get in and trade and place 100 trades a day, and you know what? Hey, some people do, but in reality, though, if that's the sort of trading style that you're employing, you've got to have a lot of discipline. I mean, if you're going to be doing that sort of trading, so discipline and patience go hand in hand, really.
They certainly do, Ty. But it's so paramount to being able to create a replicatable system. Now, whatever system you do choose, whether it's breaks of trend lines and you like to go counter to that, or it's looking for rejections around areas that you expected it to break out, and then you go, okay, I see what you've done there, and then you trade the opposite direction. Whatever it might be, a lot of systems work. We're not here to tell you any one particular one is that much better than the other. We're just saying that it's through replication that you really do create it. And I think a lot of today's session here is to really start to make you think, okay, firstly, what instrument do I want to trade? Most likely it's going to be, of course, a currency. Being with Pepperstone, we want to trade currencies. We want to trade the majors. We want to potentially look at the relative strength. If you were making the argument right now, which particular currency is weak, well, you would go to something like the odd and you would say, well, that's been pretty weak recently. You would go to something like the yens and you would say, well, it's obvious that the yens have been fairly weak against certain currencies, especially the US dollar. So if you then traded gold, you might want to go gold versus whatever the weak currency is. Find that pair. Already you're doing better than probably 90% of Forex traders out there. They don't even consider that. Find the strongest currency, find the weakest currency, and then you can pit them against each other to a degree and find the technical reasons for that breakout. The other thing is, if you have the patience and discipline, you can look for certain things that would have trapped you into the position. You can always ask yourself the simple question, Ty, would I usually have bought that? If the answer is yes, and then it goes off in the opposite direction, it's probably a hunt or some other kind of trap, and you could take advantage of that particular style of trade. So getting into trading is an exciting journey, but I think that selection of the time, selection of the instrument, of course, moving averages. We love the 20 moving average. We've shown you how to add it. using that as dynamic support resistance, Tyrone, can be incredibly, incredibly good. And especially on things like the euro US dollar, it often, really finds levels where it'll find it as dynamic resistance. Here's a classic case of just a beautiful trend. Notice before when we said the 1 and the 2. So once you have the 1, that is the first touch, and you have the second touch, and it breaks that level of support, the third, the fourth, the fifth, the sixth, the seventh, even until it's breached, all become incredibly tradable. So it's a pretty big thing, and of course, it's something that we really love to talk about here as part of the community here in Pepperstone, and obviously as part of these webinars and everything else we do. There are channeling markets as well and different patterns that you can use, but ultimately don't FOMO. That's the big thing we want to say. It's not about FOMO. No FOMO yet, Ty.
No FOMO ever. No, we absolutely. Andrew, thank you for your comment saying that we've explained a lot in this webinar. That's great. Look, a lot of what we talk about in our webinar, we've been doing this for many years now, and we've been a partner of Pepperstone's for a long time as well. Coming on our 10-year anniversary, if you can actually believe it, of working with Pepperstone. So, and we're very proud of that because, we obviously work with Pepperstone for a reason, and that's because we believe that they're the best of what they do in the currency and the CFD space. But just as importantly, though, the reason why we've been around for so long is because we believe in the strategies that we talk about, and this is what we do on an everyday level. Now, it may seem simple and you might think that you guys are just holding back. You're only really telling us, the basic concepts, but don't underestimate the power of what we've talked about tonight in terms of the moving averages in particular and the strategies that we've talked about, because really building on this knowledge alone can make you a successful trader. You don't need, a million indicators. You don't need a million different strategies. You just need to know the basics of what is actually happening. Understanding what the market is doing is the most important thing. No question. So don't think that there's a golden goose out there, because there isn't. I'm pretty sure I haven't got one in my backyard. I'm not so sure. Sometimes I see some of the things that Thomas wears, and I'm thinking maybe he has got something hidden in his backyard because it's looking pretty damn fancy. But from my understanding, we have to work very hard to actually identify trades that actually work. So there is no golden recipe. There's just a lot of understanding of what the market is actually doing. So don't underestimate what you've learned in this webinar. And, we've got, and basically everything that we've talked about and much, much more is in our Ultimate Trading Masterclass. Now, we do have an end of financial year sale. I know this is actually an international webinar, of course, but for all of you Australians out there, that the end of the financial year is only a couple of days away. I think 1 day away, actually. And we do have a sale on our Ultimate Masterclass. So if you are interested in a 50% discount to take advantage of that, I'll pop that link in the chat window actually. And look, it's a really, really good course. We have had many, many successful traders come out of it and become very, very successful in their own right just from the knowledge of that course. So feel free to jump in or ask us any questions about it, because it is our bestseller for a very, very good reason. So definitely check it out if you haven't already.
Absolutely, Ty. I'll answer this other question here, which is a good one. And it says from RY Guy, it says, what criteria do you use to determine the box? So determining a box usually is built around wicks and certain understanding of resistances and supports. And what you're looking for is, of course, distribution and supply. Usually when a trend stops, you'll have like a peak and trough area, and that area will begin the box creation. But it's a bit more in depth to be able to really create super boxes and know how to do them. Obviously, that involves a fair bit of understanding. But it's a good question, and maybe one day we'll answer it here in these sessions and these webinars. It'll
one of the advanced sessions that we'll do.
By now. It'll take a little while. Aussie Cover says the KISS principle, that is the keep it simple smarty pants. Is that right, Ty? I'm not allowed to probably say that.
I think it was stupid. I think it meant stupid.
We'll call it, it was keep it simple, stupid. And if you're interested in, of course, applying and using our end of financial year in Australia,
obviously deal, then you can use EOFY22 Ultimate. We've put it into the link description. If you enjoyed the content today, remember to give it a thumbs up. Thanks so much for joining us this week. And from both Tyrone and myself, and of course everyone at Pepperstone, we hope you have a good rest of the session. Just in terms of some news that's coming out, Ty, if anyone's watching this now, do remember we do have a little bit of economic news coming out. I believe the ECB, the Fed, and the Bank of England all speaking about half an hour before the New York opens. So if you're scalping and day trading out there, you might want to go check out that news and make sure you're aware of it. Always have an economic calendar, especially when scalping. That's a good beginner rule.
Definitely.
All right. Well, thank you very much, guys. We'll see you next time in a few weeks, and have a great day. Bye for now.
Thanks, everyone. Have a good night.